I'm going to be direct with you about something that's been troubling me lately. I've spent the past few months reviewing portfolios for investors in their 50s and 60s, and I keep seeing the same pattern. People sitting on significant capital earning next to nothing, waiting for the right moment to invest. Meanwhile, they're watching their purchasing power erode and opportunities pass them by. Let me tell you what prompted this concern. Last quarter, I met with a 58-year-old executive who had $2 million in savings accounts and short-term CDs earning roughly 4%. He was proud of his discipline, his safety, his patience. When I calculated what he was earning after taxes and inflation, the number shocked him. He was actually losing ground. While he waited for certainty, for the perfect entry point, for all the risks to disappear, he was forfeiting approximately $80,000 to $120,000 per year in potential income that properly structured investments could have generated. This isn't about being reckless. It's about understanding what waiting actually costs. I've been managing money since 1969. I've seen every market cycle, every crisis, every reason to wait that investors have conjured up over 5 decades. And here's what I've learned. The investors who wait for perfect clarity never invest. The investors who demand zero risk never earn meaningful returns. The investors who sit in cash until they feel comfortable discover too late that comfort and opportunity rarely arrive together. Right now, in early 2025, I'm watching a particularly dangerous version of this pattern unfold. Investors over 50, people who should be in their peak earning years, who have capital, who have time horizons of 20 to 30 years or more, are paralyzed. They're paralyzed by headlines. They're paralyzed by volatility. They're paralyzed by the memory of 2008 or 2022 or whatever crisis scared them most. And while they're paralyzed, they're paying an enormous opportunity cost. Let me break down what this actually means in dollars and cents, because I think when you see the mathematics of waiting, the psychology of waiting becomes harder to justify. Consider an investor with $1.5 million in investable assets. That's not uncommon for someone in their mid-50s who's been saving diligently. If that money sits in money market funds or short-term treasuries earning 4% to 5%, they're generating $60,000 to $75,000 per year in gross income. After taxes at, say, a 30% marginal rate, that's $42,000 to $52,500 in after-tax income. Subtract 3% inflation, and the real purchasing power they're adding is minimal, perhaps $20,000 to $30,000 per year. Now contrast that with a properly constructed portfolio designed for income and moderate growth. I'm not talking about speculation. I'm not talking about crypto or meme stocks or whatever the latest fad happens to be. I'm talking about the kind of portfolio Oaktree has been building for institutional investors for decades, a mix of investment-grade bonds, dividend-paying equities, real estate investment trusts, and carefully selected credit instruments. A conservative version of such a portfolio, and I emphasize conservative, might reasonably target 6% to 8% annual returns over time, with 4% to 5% coming from current income and the remainder from modest appreciation. On that same $1.5 million, you're now looking at $60,000 to $75,000 in annual income alone before any growth. After taxes, that's $42,000 to $52,500. But here's the crucial difference. You're also positioned for capital appreciation, you're diversified across asset classes, and you're actually invested in productive assets rather than just lending money to the government at rates that barely keep pace with inflation. The difference compounds dramatically over time. Let's say you're 55 years old. You have a 30-year time horizon before you're 85. If you keep $1.5 million in cash equivalents earning 4% and you withdraw nothing, you'll have approximately $4.9 million in 30 years. Sounds impressive until you realize that at 3% annual inflation, that's worth only about $2 million in today's dollars. You've barely kept pace. But if you invest that same $1.5 million in a balanced portfolio, earning 7% annually, even with the same inflation rate, you're looking at approximately $11.4 million in 30 years, or about $4.7 million in today's purchasing power. The difference is $2.7 million in real wealth. Wealth you could pass to your children, use for health care, donate to causes you care about, or simply enjoy. That's the cost of waiting. That's what safety actually costs when you're sitting in cash during your peak earning years. Now I can already hear the objections. But Howard, what about risk? What about volatility? What about the next crash? These are legitimate concerns. I've never dismissed risk. My entire career has been built on understanding, measuring, and managing risk. But there's a crucial distinction I want you to understand. The risk of volatility is not the same as the risk of permanent capital loss. Volatility means your portfolio value fluctuates. Some years it's up 15%, some years it's down 8%, some years it's flat. Over time, if you've invested in quality assets at reasonable prices, the trajectory is upward. But in any given year, you might see your portfolio decline. That's volatility. And it's the price you pay for long-term returns. Permanent capital loss means you invest in something that goes to zero and never recovers. You buy a company that goes bankrupt. You lend money to a borrower who defaults, and you recover nothing. You invest in a fraud. That's what you should actually fear. Here's what I've observed over 50 years. Investors who confuse volatility with risk make terrible decisions. They see their portfolio decline 10% and panic, selling at the bottom. They watch cash sit stable and feel smart, not realizing they're losing purchasing power every single day. They equate the absence of volatility with the presence of safety, which is one of the most expensive cognitive errors in investing. If you're 55 years old with a 30-year time horizon, volatility is not your enemy. In fact, volatility can be your friend if you have the discipline to rebalance, to buy when others are selling, to maintain your allocation through cycles. What is your enemy is sitting in cash earning returns that don't keep pace with inflation, forfeiting a decade or more of compounding, and waking up at 70 realizing you can't make up for lost time. Let me tell you about a decision I made in 2009 that illustrates this principle. In March 2009, the S&P 500 had fallen nearly 60% from its peak. Credit markets were frozen. Banks were failing. The world felt like it was ending. I had clients calling me, terrified, asking if they should sell everything and go to cash. I didn't know if the market would fall another 20%. I didn't know if we were headed for a depression. I didn't know if the financial system would survive, but I knew one thing. Assets were cheap. High-quality companies were trading at valuations I hadn't seen in decades. Investment-grade bonds were yielding 8%, 10%, 12%. The risk-reward ratio had shifted dramatically in favor of investors who had capital and courage. So we invested, aggressively. We deployed capital into distressed debt, into beaten-down equities, into credit instruments that were mispriced because everyone else was too scared to act. And yes, there was volatility. The market bounced around. Some positions went down before they went up. But over the next 5 years, those investments generated returns that our clients will benefit from for the rest of their lives. The investors who went to cash in 2009? They missed one of the greatest buying opportunities in modern history. They felt safe. They felt smart. They waited for certainty. And by the time they felt comfortable investing again, prices had doubled or tripled, and the opportunity was gone. I'm not suggesting we're in a 2009 type crisis right now in 2025. We're not. But I am suggesting that the psychology is similar. Investors are waiting for perfect conditions that will never arrive. They're demanding certainty in an uncertain world. They're prioritizing the feeling of safety over the reality of returns, and they're paying an enormous price for that psychological comfort. Here's another way to think about this. Let's say you're 52 years old and you plan to work until you're 65. That's 13 years of peak earning power remaining. If you have $1 million invested and it generates 6% annually, that's $60,000 per year in investment income. Income that supplements your salary, reduces your dependence on work, gives you options. Over 13 years, that's $780,000 in cumulative income, plus whatever capital appreciation you've achieved. But if that $1 million sits in a savings account earning 3%, you're generating $30,000 per year, or $390,000 over 13 years. The difference is $390,000, nearly 40% of your original capital that you forfeited by choosing safety over sensible investment. And here's what really concerns me. Those 13 years are irreplaceable. You can't get them back. When you're 65, you can't go back to age 52 and reinvest that money. You can't recapture the compounding you missed. You can't undo the opportunity cost. Time is the one asset that even the wealthiest investors can't buy more of, and wasting it is the most expensive mistake you can make. Now, I want to be clear about something. I'm not advocating recklessness. I'm not suggesting you take your life savings and buy speculative stocks or chase the latest investment fad. What I am suggesting is that you stop treating cash as a long-term investment strategy. Cash is a tool for liquidity, for short-term needs, for maintaining optionality. But if you're over 50 and sitting on significant cash balances because you're waiting for the right time to invest, you're making a strategic error that will cost you dearly. So, what should you do instead? Let me share how I think about portfolio construction for investors in this situation. And remember, this is how I've approached investing for 5 decades, through every market environment imaginable. First, accept that you cannot eliminate risk. You can only choose which risks to take. The risk of volatility, the risk of inflation, the risk of missed opportunity, these are all real risks, and you're going to bear some combination of them no matter what you do. The question is, which risks are you most able to tolerate given your situation, and which risks offer the best compensation for bearing them? For most investors over 50, I believe the risk of sitting in cash, the risk of inflation eroding your purchasing power, the risk of forfeiting compounding, the risk of running out of money in your 80s or 90s is far greater than the risk of a well-diversified portfolio experiencing temporary volatility. But each investor needs to make that assessment for themselves based on their specific circumstances. Second, build a portfolio that generates income. This is crucial for investors over 50 because income provides psychological comfort during volatile periods. If your portfolio is generating $70,000 or $80,000 or $100,000 per year in dividends, interest, and distributions, you're less likely to panic when the market value fluctuates. You can see the tangible benefit of being invested. You're getting paid to wait for long-term appreciation. This means allocating to dividend-paying stocks, investment-grade bonds, real estate investment trusts, preferred securities, and other income-producing assets. It means building a portfolio where 4% to 6% of your capital is returned to you every year in cash flow, independent of what the market does. That income is real. It's spendable. It's not dependent on selling at the right time or timing the market correctly. Third, diversify across asset classes and across time. Don't try to invest all your capital on a single day at what you hope is the perfect moment. That's market timing, and market timing doesn't work. Not for me, not for anyone. Instead, invest systematically over a period of months. Dollar cost average into your positions. Build your portfolio gradually. This removes the pressure of trying to call the exact bottom and ensures you're participating in the market regardless of short-term fluctuations. At Oaktree, when we're deploying capital, we don't wait for the perfect moment. We invest when we find assets trading at attractive valuations relative to their intrinsic value. Sometimes we're early, sometimes we're late, but we're always invested in proportion to the opportunities we're seeing. That's how you build wealth over decades. Fourth, maintain a long-term perspective. I cannot emphasize this enough. If you're 55 years old, you do not have a 5-year time horizon. You have a 30-year time horizon. You're going to live into your 80s or 90s. Your portfolio needs to support you through 3 decades of retirement. That means you need growth, not just preservation. You need your capital to compound, not just sit stable. The biggest mistake I see investors over 50 make is thinking of themselves as conservative investors who should be mostly in cash and bonds. That might have made sense when life expectancy was 70 and bond yields were 8%. But in 2025, when you might live to 95 and cash yields barely exceed inflation, that strategy is a recipe for running out of money. You need equity exposure. You need real assets. You need investments that will grow in value over time, not just return your principal. And yes, that means accepting volatility. But volatility over a 30-year period is noise. What matters is whether you're invested in productive assets that compound in value over decades. Fifth, ignore the noise. The financial media exists to generate anxiety. Every day there's a new crisis, a new reason to worry, a new prediction of doom. I've been hearing these predictions since 1969. I've heard that the market is going to crash, that the economy is going to collapse, that we're headed for disaster thousands of times. And you know what? Sometimes those predictions are right. Markets do crash, economies do contract, crises do occur. But over any meaningful time period, the trajectory of productive assets is upward. Companies innovate, economies grow, human ingenuity creates value. If you're constantly reacting to headlines, constantly moving to cash when things feel scary, constantly waiting for certainty before you invest, you're going to miss the compounding that makes long-term investing work. I don't watch CNBC. I don't check my portfolio every day. I don't make investment decisions based on what happened in the market yesterday. I focus on fundamentals, on valuations, on whether the assets I own are likely to generate attractive returns over the next decade. Everything else is noise. Sixth, work with someone who understands your situation. I'm not suggesting everyone needs to hire Oaktree Capital Management. We work with institutions, not individuals. But you should work with an advisor who understands the specific challenges facing investors over 50, who can construct a portfolio appropriate for your risk tolerance and time horizon, who can keep you disciplined during volatile periods. The value of a good advisor isn't in beating the market. Very few people can do that consistently. The value is in preventing you from making emotional decisions that destroy wealth, selling at the bottom, chasing performance at the top, sitting in cash for years because you're scared. A good advisor earns their fee by keeping you invested through cycles, by maintaining your discipline, by helping you avoid the behavioral mistakes that cost investors far more than any fee ever could. Let me share one more story that I think captures the essence of what I'm trying to convey. In 1999, I had a client who was 53 years old, a successful business owner who had just sold his company for $5 million. He wanted to invest the proceeds, but he was nervous about the stock market. The dot-com bubble was in full swing, valuations were absurd, and he felt like he'd be buying at the top. So he waited. He kept the money in treasury bills. He told himself he'd invest when things calmed down. Then the market crashed in 2000, and he felt vindicated. He'd avoided the crash. But he still didn't invest because now the economy was in recession and it felt risky. Then 9/11 happened, and he definitely wasn't going to invest during a crisis. Then we invaded Iraq, and geopolitical risk was too high. Then the housing market started to look bubbly, so he waited for that to resolve. By 2007, 8 years after he'd sold his business, he was still sitting in cash. He'd earned maybe 3% per year on his treasury bills. He'd missed the entire recovery from 2003 to 2007, and then the financial crisis hit, and once again he felt vindicated. He'd avoided another crash. But here's the tragic part. He never invested. He's 77 years old now, still sitting mostly in cash, still waiting for the right moment. His $5 million has grown to maybe $7 million over 25 years, a 1.4% annual return. If he'd invested in a balanced portfolio in 1999, even buying at the peak of the dot-com bubble, even suffering through two major crashes, he'd have somewhere between $15 million and $20 million today. He'd have tripled or quadrupled his wealth instead of barely keeping pace with inflation. That's the cost of waiting. That's what happens when you let fear override logic, when you prioritize the feeling of safety over the reality of returns, when you convince yourself that the right moment is always just around the corner. I don't want you to be that person. I don't want you to wake up at 75 or 80 and realize you've wasted the most important compounding years of your life sitting in cash because you were scared. I don't want you to discover too late that the safety you felt was an illusion, that inflation and opportunity cost were destroying your wealth just as surely as a market crash would have, but more slowly and invisibly. Here's my final point, and it's the most important one. You cannot afford to wait. If you're over 50, if you have capital sitting in cash, if you've been telling yourself you'll invest when things feel more certain, you need to understand that you're making an active decision with real consequences. You're choosing inflation risk over volatility risk. You're choosing missed opportunity over temporary fluctuation. You're choosing the illusion of safety over the reality of compounding. I've been doing this for 56 years. I've managed through the 1987 crash, the savings and loan crisis, the dot-com bubble, the financial crisis, the pandemic, and every other scary moment in between. And here's what I know with absolute certainty. The investors who build wealth are not the ones who wait for perfect conditions. They're the ones who invest systematically, who maintain discipline, who accept volatility as the price of returns, who stay invested through cycles. The investors who wait, who sit in cash, who demand certainty, who let fear paralyze them, they don't build wealth. They preserve capital in nominal terms while watching it erode in real terms. They forfeit compounding. They miss opportunities. And they wake up in their 70s or 80s realizing they can't make up for lost time. You're over 50. You have capital. You have time. You have the opportunity to generate meaningful returns that will support you through retirement, that will give you options, that will allow you to live the life you want. But only if you stop waiting. Only if you accept that uncertainty is permanent, that volatility is the price of returns, that the right moment to invest is when you have capital and a long time horizon, which is right now. I can't tell you what the market will do tomorrow or next month or next year. I never could. But I can tell you this. If you're sitting on significant cash balances, earning 3% or 4% or 5%, watching inflation erode your purchasing power, forfeiting the compounding that could generate $100,000 or more per year in income, you're making a mistake. A costly, irreversible mistake. Don't let fear cost you your financial future. Don't let the illusion of safety rob you of the reality of returns. Don't wait for certainty that will never come. Invest, diversify, maintain discipline, stay the course. That's how you build wealth. That's how you generate income. That's how you ensure that your capital works for you instead of sitting idle while opportunities pass you by. That's what I've learned over 5 decades. I hope it helps you think differently about the cost of waiting and the value of acting.